highest possible level of profit for a company within a specific period. This typically involves strategies aimed at increasing revenues, decreasing cost, or both, aiming to maximize the difference between total revenues and total expenses. So in simpler terms, it's about making the most money possible for the businesses in the short term or over a defined period. It's a straightforward concept that emphasizes the income statement's bottom line. So the statement, profit maximization, is the traditional and narrow approach in financial management, which highlights several key points discussed in the next slide. Traditional approach. First is historical emphasis. So in the earlier days of businesses and economic thought, profit was often seen as a primary, if not sole, measure of success. So the focus was largely on generating the highest possible accounting profit within a period. Secondly, simplicity and measurability. Profit is a relatively straightforward concept to understand and measure using accounting principles, making it a convenient and widely adopted metric for evaluating performance. Narrow approach. So the narrowness of profit maximization stems from its limitations in capturing the full complexity of financial goals and the factors contributing to long-term business success and value. So here's why it is considered narrow. Ignores the time value of money. As explained previously, profit maximization doesn't differentiate between profits earned today and profits earned in the distant future. A dollar earned today is worth more than one earned in 5 years due to the potential for investment and earning interest. That is opportunity cost. It disregards risk. So different business decisions and projects carry varying levels of risk. So a strategy that promises high profits might also be highly risky, potentially leading to significant losses. So profit maximization doesn't explicitly factor in this risk-return trade-off. Short-term focus. The emphasis on maximizing current profits can lead to decisions that are detrimental to the company's long-term health and sustainability. For example, cutting back on research and development, employee training, or maintenance might boost short-term profits but harm the company's competitive edge and prospects. Ambiguity of profit. The term profit can be interpreted in various ways. Example, accounting profit, economic profit, pre-tax profit, and after-tax profit. So this lack of a clear and consistent definition can make the profit maximization a less precise goal. Ignore the impact on shareholder wealth. So while profit are important, the ultimate goal of a publicly traded company is generally considered to be maximizing the wealth of its shareholders. So shareholder wealth is reflected in the stock price, which is influenced by factors beyond just current profits, including future growth prospects, risk, dividend payments, and market conditions. While seemingly straightforward, focusing solely on profit maximization, which has several significant limitations and has led to the broad acceptance of wealth maximization as the primary goal of financial management. So these limitations include: ignores the time value of money. So profit maximization doesn't consider when the profits are received. So higher profit earned in the distant future is generally less valuable than the same profit earned today due to the time value of money. The concept that money available at the present time is worth more than the same amount in the future due to the potential earning capacity. It ignores risk. So different projects and decisions carry different levels of risk. So profit maximization doesn't explicitly account for this risk. A high profit project might also be very risky, potentially leading to significant losses. It focuses on short term. A sole focus on maximizing current profit might lead to decisions that are detrimental to the long-term health and sustainability of the company. For example, development or employee training might boost short-term profits but harm the company's future prospects.
Hi, welcome.
Ignore social and ethical considerations. A relentless pursuit of profit maximization can sometimes lead to unethical or socially irresponsible behavior such as exploiting labor, damaging the environment, or engaging in unfair business practices. So this can ultimately harm the company's reputation and long-term value.
Hello.
So what's the ambiguity? So ambiguity, the term profit itself can be ambiguous. Should it be accounting profit, economic profit, profit before tax, or profit after tax? What is this? So the time frame for maximization also isn't clearly defined. It ignores the shareholder wealth. Profit maximization focuses on the company's earnings, but the primary goal of a publicly traded company should be to maximize the wealth of its shareholders, which is reflected in the stock price. So factors beyond just profit, such as dividends, future growth prospects, and risk influence shareholder wealth. So next is the wealth maximization. So wealth maximization, also known as shareholder wealth maximization, which is widely accepted primary goal of financial management in modern business. It goes beyond simply maximizing profit and focuses on increasing the overall value of the firm for its owners, the shareholders. So this is typically reflected in the maximization of the company's stock price in the long run. Focus on shareholder value. The ultimate aim is to make decisions which will increase the market value of the company's share, and this benefits shareholders directly through capital appreciation and potential dividend payouts. Long-term perspective. Unlike profit maximization, wealth maximization takes a long-term view, and it considers the future profitability, growth prospects, and sustainability of the company, not just short-term gains. It considers the time value of money. So wealth maximization explicitly incorporates the concept that money received today is worth more than the same amount received in the future. So financial decisions are evaluated based on the present value of expected future cash flows. Accounts for risk. So different business decisions and investment carrying varying levels of risk. So wealth maximization considers this risk-return trade-off, aiming for a balance that maximizes shareholder value given the level of risk involved. So high risk projects need to offer the potential for high returns to be considered value enhancing. Broader scope. Wealth maximization considers all factors influencing the company's stock price, including the profitability, growth opportunity, risk profile, dividend policy, market conditions, and management efficiency. Alignment of interest. So by focusing on shareholders' wealth, management interests align more closely with those of the company's owners. So as discussed earlier, profit maximization suffers from several limitations that wealth maximization addresses. First, time value of money. So wealth maximization explicitly considers the timing of cash flows. Secondly, risk consideration. So wealth maximization incorporates the level of risk associated with different decisions. Third, long-term perspective. Wealth maximization focuses on the long-term sustainable growth and value of the company. So dear learners, the question is why wealth maximization is preferred over profit maximization. So first is broader scope. It considers all factors influencing shareholder value, not just accounting profits. Secondly, it clearer objective. Maximizing stock price provides a more concrete and measurable objective for management. For example, wealth maximization views the firm as an ongoing entity whose primary financial goal is to increase the net worth of the shareholders over time. So this is achieved by making strategic decisions which enhance the present value of the expected future cash flows of the company while carefully considering the associated risk. And it is more comprehensive and forward-looking approach to financial management than simply focusing on maximizing current profit. So now in this, we discuss about the difference between profit and wealth maximization. The first is aim. So in profit, maximizing the company's accounting profit. In wealth, it maximizing the firm's overall value of its owner shareholders. Second, time horizon. So in profit, it typically short-term, example annual profit. In wealth, it long-term, considering future profitability and sustainability. Third, risk consideration. In profit, largely ignores or doesn't explicitly account for risk. In wealth, it explicitly considers the risk return trade-off on decision making. Next is time value of money. In profit, it generally disregards the time value of money. But in wealth, it explicitly considers the time value of money, present value of future cash flows. Scope. In profit, it narrow focus on the income statement, that is revenues and cost. But in wealth, it broader focus encompassing all factors affecting the company's market value, profitability, growth, risk, dividends, market conditions, etc. The stakeholder view. In profit, it primarily focused on the company's financial performance. In wealth, it primarily focused on maximizing the wealth of shareholders. So question 1, from a pure profit maximization standpoint, what action should Mrs. Gable take? So answer is, from a pure profit maximization standpoint, Mrs. Gable should sell the bakery now and realize a large one-time profit from Question 2, from a wealth maximization standpoint, what factors should Mrs. Gable consider beyond the immediate profit? So answer is, from a wealth maximization standpoint, Mrs. Gable should consider the following factors beyond the immediate profit. First is time value of money. While the lump sum is large now, the bakery could generate a steady stream of income for many more years. So the present value of this future income needs to be considered. Second factor, risk. Selling now guarantees a large sum with minimal future risk related to operating the bakery. However, relying solely on this lump sum for retirement carries its own investment risk. Third, future growth potential. Even without selling, the bakery might have opportunities for expansion or increased profitability in the future, adding to its overall value, that is wealth. Next is the intangible assets. The bakery has built goodwill, a loyal customer base, and a strong brand over 30 years. Selling might forfeit this valuable asset, which could have contributed to future earnings or a higher selling price later. Personal and non-financial factors. So Mrs. Gable's enjoyment of the business, her relationships with staff and customers, and the sentimental value are the part of her overall well-being, which can be considered a form of wealth beyond just monetary value. Question 3, which perspective do you think aligns better with the long-term financial well-being of Mrs. Gable and potentially her family? So the perspective that aligns better with the long-term financial well-being of Mrs. Gable and potentially her family's wealth maximizations. Here's why. Because while profit maximization offers a large immediate gain, wealth maximization encourages a more holistic view of financial value over time. So the consistent income stream from a successful business, even if smaller annually than the one-time sale profit, can provide long-term financial security and potential for gradual growth. It also acknowledges the time value of money. Investing the proceeds from the sale is an option, but it comes with its own risk and requires financial expertise. So well-run business can be a reliable source of wealth generation. Furthermore, wealth maximization isn't solely about the highest immediate cash influx. It considers the sustainability and potential for future income and asset appreciation. So the bakery, as an established and successful entity, has inherent value that might continue to grow. Ultimately, Mrs. Gable's personal circumstances, her desire for continued engagement, even part-time, and her plans for the future will influence her decision. However, from a long-term financial perspective, considering the present value of future earnings and the potential for sustained value creation, that is wealth maximization, is generally a more prudent approach than solely focusing on a one-time profit. Now let us summarize. So dear learners, in this topic, you have learned that financial management aims to achieve goals primarily
Hello, welcome. Hi, Mick.
They come from. So effective financing decisions aim to secure the necessary funds at the lowest possible cost while considering the associated risk and maintaining a very healthy financial structure for the company. Key sources of financing decisions. So first is identifying the funding needs. The first step is determining the total amount of funds the company requires, and this involves considering long-term needs, this includes the capital expenditures such as purchasing new equipment or buildings or investing in research and development. Another one is short-term needs. So working capital requirements such as inventory accounts, receivable, and day-to-day operating expenses. Choosing the sources of funds. So once the funding needs are identified, the company must decide on most appropriate sources of the finance, and these can broadly be categorized into equity financing, and that is raising capital by selling ownership stakes in the company, that is issuing shares. Another one is common stock. It represents basic ownership and voting rights. Preferred stock, which has preference over common stock regarding dividends and asset distributions during liquidation, but usually lacks voting rights. Retained earnings. So profit generated by the company, which are invested in the business instead of being distributed as dividends, and this is a form of internal equity financing. Debt financing. So by raising capital by borrowing funds that must be repaid with interest. That is in the term of short-term debt. So loans or credit facilities with a maturity of 1 year or less. For example, bank overdraft, commercial paper, short-term loans. And another one is long-term debt, loans or bonds with a maturity of more than 1 year. For example, term loans, debentures, bonds, etc. Hybrid financing. So instruments that have characteristics of both debt and equity. For example, convertible bonds, preference shares with debt-like features. So third is to determine the optimal capital structure. So this involves deciding on the ideal mix of debt and equity financing for the company. The capital structure significantly impacts the company's financial risk and return. So factors influencing the optimal capital structure include cost of capital, which is the rate of return the company must earn on its investment to satisfy its investors, that is both debt and equity holders. So debt is often cheaper than equity due to the tax deductibility of interest payments. Another one is financial risk. So the risk that the company will not be able to meet its debt obligations. For example, interest and principal payments. So higher levels of debt increase the financial risk. So business risk is the inherent risk associated with the company's operations and industry. So companies with stable earnings may be able to take on more debt, which depends on market conditions, which is prevailing interest rates and investor sentiment can influence the attractiveness and availability of different financing sources. The fourth one is evaluating financing options. So each potential source of financing needs to be carefully evaluated based on several factors. That is cost, which is interest rates on debt, expected return on equity, issuance cost. Another one is risk, which is level of financial leverage, repayment obligations, dilution of ownership. And the last is maturity, the repayment schedule for debt and performance of equity. The flexibility, which is the ability to repay early, raise more funds in the future, adapt to changing circumstances. Control, which is impact on the voting rights and control of existing shareholders. Legal and regulatory requirements, so compliance with securities, laws and other regulations. So how to implementing the financing plan? So once the decisions are made, the company needs to execute the financing plan, which may involve negotiating loan terms, issuing securities, and managing the inflow of funds. Monitoring and review. So financing decisions are not static. The company needs to continuously monitor its capital structure, market conditions, and funding needs, and be prepared to make the adjustments as necessary. So next is the investment decisions. So investment or capital budgeting or capital expenditure, in short, capex. Decisions are crucial in financial management, and they involve determining how a company will allocate capital to long-term assets expected to generate returns over more than 1 year. These decisions are fundamental to a company's growth, profitability, and overall value. Essentially, investment decisions answers the question, what long-term assets should the company invest in? So these assets range from tangible assets like plant, machinery, and buildings to intangible assets like patents, trademarks, and research and development projects. To identify the investment opportunities. So the process begins with identifying the potential investment projects that align with the company's strategic goals and objectives. So these opportunities can arise from various sources such as expansion, which is to increasing production capacity, entering new markets, or launching new product lines. Replacement, replacing old or obsolete assets with newer, more efficient ones. And diversification, which entering new industries or product categories. To evaluating investment proposals. So once potential investment opportunities are identified, they must be carefully evaluated to assess their financial viability and attractiveness. And this involves to estimating the cash flows, which projecting the expected future cash inflows, for example, revenues, cost savings, and cash outflow, that is initial investment, operating expenses, associated with each project over its useful life, which is critical and often challenging, as it involves forecasting future events. To analyzing risk, by assessing the level of uncertainty associated with the project cash flows, different projects carry different risk levels, which need to be factored into the evaluation. To apply capital budgeting techniques, so by using various financial tools and techniques to analyze the profitability and feasibility of the investment proposals. Third, selecting profitable projects. So it's based on the evaluation using capital budgeting techniques and considering the company's strategic objectives and risk appetite decisions which are made on which projects to accept and which to reject. So typically, projects with positive NPV, IRR above the cost of capital, a reasonable payback period, so which used as a supplementary measure, and a PI greater than 1 are considered for acceptance. 4. Funding the projects. So once the investment decisions are made, the company needs to allocate the necessary funds, and this links back to the financing decisions, where the company determines the sources of capital, debt, equity, or retained earnings to finance the approved investments. Fifth, implementing and monitoring projects. So after funding is secured, the projects are implemented, and it's crucial to monitor the progress of these investments to track the actual cash flows against projections and to take corrective actions if necessary. So post-audit reviews a project actual performance after it has been implemented to assess the accuracy of the initial estimates and identify any lessons learned for future investment decisions. So at last, investment decisions are a crucial function of financial management, and they require careful analysis, evaluation, and consideration of financial and strategic factors to ensure that the company's capital is allocated efficiently to projects and that will generate long-term value and contribute to achieving its overall goals. Dividend decisions. Now, dividend decisions, which are crucial aspect of financial management that involve determining how much of a company profits will be distributed to shareholders as dividends and how much will be retained with the company for reinvestment. So these decisions significantly impact both the shareholders' returns and the company's future growth potential. So essentially, dividend decisions answer this question: how should the company's profit be split between shareholders and reinvestment? Key sources of dividend decisions. Determining distributable profits. The starting point is to identify the profit available for distribution to shareholders, and this is typically the net profit after taxes. But companies may consider factors like free cash flow and retained earnings. Factors influencing dividend decisions. So several factors influence a company's dividend policy and the specific dividend payout. That is profitability. So companies with higher and more stable profits are generally more likely to pay dividends. For liquidity, the company must have sufficient cash to pay dividends without affecting its operational needs. Growth opportunities. So companies with significant profitable investment opportunities may choose to retain more earnings for reinvestment rather than paying high dividends. Forms of dividends. So dividends can be distributed to shareholders in various forms. That is cash dividends, the most common form, where shareholders receive a direct cash payment per share held. Stock dividends, that is bonus shares, distribution of additional shares to existing shareholders in proportion to their holdings. And this doesn't involve any actual cash outflow from the company but dilutes the earnings per share. Dividend policies. Companies often establish dividend policies that provide a decision-making framework. So common dividend policies include stable dividend policy, which maintaining a consistent dividend payout over time, even if earnings fluctuate. And this can provide a stable income stream for investors and reduce uncertainty. Constant payout ratio policy. By paying a fixed percentage of earnings as dividends, this means dividend payments will fluctuate with earnings. Impact of dividend decisions. So dividend decisions have several important implications. First, shareholder wealth. So dividends provide a direct return to shareholders, contributing to your overall wealth. However, retained earnings can also increase shareholder wealth through future growth in the stock price. Another one is a company's financial position. Dividend payouts reduce retained earnings and cash reserve, potentially impacting the company's ability to fund future investments or rather financial difficulties. So dear learners, in conclusion, dividend decisions are a critical balancing act for financial managers, and they must weigh the desire to provide policy that considers the company's specific liquidity decisions, which is financial management concern ensuring that a company has sufficient liquid assets, that is, assets that can be easily converted into cash to meet its short-term financial obligations as they come due. So these obligations include paying suppliers, salaries, short-term loans, and operating expenses. Essentially, liquidity decisions answer this question: does the company have enough readily available cash to pay its bills on time? So there are key aspects of liquidity decisions. Managing current assets. So this involves efficiently managing the company's short-term assets. Cash. Determining the optimal level of cash to hold enough to meet obligations but not so much that it's unproductive. Marketable securities. Investing excess cash in highly liquid short-term investments. Accounts receivable. Implementing effective credit and collection policies to ensure timely customer payments. Inventory. Optimizing inventory levels to avoid both stockouts and excessive holding cost. To managing current liabilities. So this involves strategically managing the company's short-term debts. Accounts payable. Negotiating favorable payment terms with suppliers to maximize the time to pay. Short-term loans. Utilizing short-term borrowing options, example lines of credit, to cover temporary cash shortfalls. Accrued expenses to managing expenses incurred but not paid, example wages payable, taxes payable. Third is the working capital management. So liquidity decisions are a core part of a working capital management, which focuses on the efficient management of current assets and current liabilities. So the goal is to maintain a healthy level of net working capital, and which is current assets and current liabilities, to ensure the smooth operations. Fourth, cash flow forecasting. So accurately predicting future cash inflows and outflows is crucial for making informed liquidity decisions, and this helps to identify the potential cash shortages or surpluses in advance. So at last, liquidity decisions are vital for a company's short-term financial health and survival. So by effectively managing its current assets and liabilities, and by continuously monitoring its cash flow and liquidity ratios, a company can ensure it has the necessary resources to meet its immediate obligations and operate smoothly. So in this topic, you have learned that comprehend the functions of the financial manager. So in this, you now understand the key responsibilities of a finance manager, which generally revolve around planning, organizing, directing, and controlling an organization's financial activities. To understand the financing decisions, you have learned that the decisions involve determining how a company will raise the funds it needs. To understand the investment decisions, you have learned that these decisions, also known as capital budgeting, involve deciding how a company will allocate its capital to long-term assets expected to generate returns over time. To understand the dividend decisions, you have learned that the decision involves determining how much of a company's profit will be distributed to shareholders as dividends and how much will be retained for investment. To understand the liquidity decisions, so you have learned that the decisions focus on ensuring the company's.
Hi, welcome, Dia.
Of how the critical financial activities of a company are managed and coordinated. So dear learners, the learning objectives. So by the end of this topic, you will be able to identify and describe the common organization structure,
Hi, how are you?
to understand the key roles and responsibilities, to recognize the relationship between the financial organization and overall business strategy. So let us understand in detail in the next few slides. To identify and describe the common organization structures. So this objective aims for you to recognize and articulate how a finance department can be set up within a company. So first is understand the difference between centralized versus decentralized. So centralized, in a centralized structure, most major financial decisions and activities are controlled and coordinated from a single corporate finance department. So this can describe the characteristics of this model. Example, standardization, economies of scale, strong corporate control, and it might be suitable for example smaller companies with highly integrated operations. Another one is a decentralized. So in a decentralized structure, financial responsibilities are distributed across different business units or divisions. So each with its finance team reporting to the unit management and a central finance function. Second is the functional versus divisional. So functional. A functional structure groups finance activities based on specialized roles. For example, accounting, treasury, financial planning, and analysis. So tasks are divided and coordinated within this structure when they are commonly used. For example, smaller to medium-sized companies. Divisional. In a divisional structure, finance teams are organized around different business units, product lines, or geographic regions. So how financial responsibilities are aligned with specific business segments and when the structure is typical. For example, large, diversified companies with distinct business units. Matrix structure. So this is a more complex structure in which finance professionals may report to a functional manager and a project or a business unit manager. So this objective focuses on your ability to identify the common positions within a finance department and clearly articulate the main duties and areas of accountability for each role. Chief Financial Officer, CFO. So overall responsibility for the financial health of the company is strategic financial planning, relationship with investors and lenders, and often involved in high-level decision making. Controller or Chief Accounting Officer. Oversees accounting functions, financial reporting, internal controls, and tax compliance, and is often responsible for preparing financial statements. Treasurer, which managing the company's cash flow, banking relationships, investments, and financing activities. Financial analyst, so analyzing financial data, providing insights and recommendations for decision making, budgeting, forecasting, and performance analysis. Accountant for various levels, recording financial transactions, maintaining financial reports, preparing reports, and ensuring accuracy and compliance. Internal auditor, evaluating the effectiveness of internal controls, risk management processes, and compliance with policies and regulations. Relationship between finance and accounting. So finance and accounting are distinct but highly independent functions within an organization. First is accounting, which primarily concerned with the recording, classifying, summarizing, and reporting of past financial transactions. So it's about creating an accurate and systematic record of what has already happened financially. Finance, primarily concerned with managing the organization's money and making strategic decisions about its acquisition and use. And it's about planning for the future and maximizing the organization's value. The relationship between finance and marketing, which is a strong and collaborative relationship between finance and marketing, which is crucial for driving sustainable growth and profitability. So finance provides a financial framework, resources, and performance measurement, while marketing generates the revenue that fuels the organization. So effective communication, shared goals, and mutual understanding are key to maximizing both functions' contribution to the business overall success. The relation between inventory and sales. The store administrations and marketing management must be coordinated to ensure customer satisfaction and goodwill. So however, investing in inventory requires financial clearance because funds are locked in and the funds are so blocked have an opportunity cost of capital. So the relationship between inventory and sales is fundamental to a business success. So effective inventory management, which aligns with sales demand, is essential for maximizing revenue, minimizing cost, and achieving profitability. The relationship between finance and production, that is operations. So finance and productions are critically independent departments that must work closely together to ensure the efficiency, profitability, and overall success of a manufacturing or product-based organization. Production role. So the efficient creation, manufacturing, or delivery of goods and services. This involves managing resources like materials, labor, equipment, optimizing processes, ensuring quality, and meeting production targets. So what is the finance role? To managing the organization money, making strategic decisions about its acquisition and use, to ensuring financial stability and maximizing shareholder wealth. The relation between finance and HR. Finance and HR are increasingly interdependent and must collaborate effectively to achieve the organization's strategic and financial goals. So what is HR role? Human resource, managing the organization workforce to ensuring it has the right people with the right skills at the right time. And this involves talent acquisitions, employee development, compensation and benefits, employee relations, legal compliance, and fostering a positive work environment. Finance role, managing the organization money, making strategic decisions about its acquisition and use to ensuring financial stability and maximizing shareholder wealth. Summary. Now let us summarize. In this topic, you have learned that organizations structure their finance functions in various ways like centralized, decentralized, functional, divisional, matrix. So depending on factors like their size and operational complexity. Specific key roles exist within a finance department such as
Hi, welcome. How are you? It's open. Legal team. Tentacles. Not this one, this one. Hi, welcome. Nice. Objective function which means active loss risk sign value for okay. Should find destination to loss or agency problem depends on agency problem is conflict between surroundings. Okay. Okay guys, bye bye, take care, good night, bye.